The consultation paper, A Fairer Way of Calculating Trust Charges, was issued on the 6th of June and gives us more information on how inheritance tax will apply to discretionary trusts. There's more detail on this subject in the TechLink bulletins in the trust taxation section that you can find on TechLink Professional. The three highlights to take from this latest consultation are: first, that a set law will only have one nil rate band to spread among all the trusts he or she creates on or after the 7th of June. Secondly, that these new provisions will only apply to trusts created on or after the 7th of June. And third, that we are still looking at a flat 6% rate to apply to the value of the trust property above the nil rate band that has been attributed to that property when calculating charges for trusts created on or after the 7th of June. So what will these changes mean if implemented? And by the way, the consultation will run until the 29th of August. We expect some draft legislation in October and the legislation to be enacted in the 2015 Finance Bill. Well, what they mean, apart from the flat 6% rate simplifying the calculation process, is that it will no longer be possible for an individual to create a series of trusts, even on successive days, with each trust having its own nil rate band, so-called RISAF principle. This principle was based on the premise that each trust would have its own nil rate band, less the value of any transfers made by the set law in the 7 years preceding the date that that trust was created. So that if you had fairly or very low value transfers into trusts, even if they were created on separate days, each trust would have its own nil rate band fully intact. For example, in the RISAF case, the individual who set up the trust was establishing a company, and from outset, those company shares were worth nothing, but that person anticipated the shares being worth an awful lot more in the future. So with that anticipation, he created a series of trusts on separate days, each with a number of shares in that trust. Now, Trust 1 was established, it made no previous transfers in the previous 7 years, and so it had its own nil rate band. Trust 2 was established on the next day, or very soon after, and there had still been no substantial transfers made by the transfer in the previous 7 years because they were nominal value shares. So that next trust had its own nil rate band. Point was here that trusts were not related unless they were created on the same day. So create trusts on separate days, each trust would have its own nil rate band, only reduced by transfers made by the set law in the previous 7 years. That meant that this principle also worked very well for life insurance policies, where you could set up a protection plan. The premiums that were paid into policy number 1 would be within the annual exemption and would be minimal. Premiums paid into policy number 2, created on the next day, would also be minimal, and number 3, and so on. So each of these life policy trusts would have their own nil rate band. The same for loan trusts, the same for pilot trusts. Low value entry property, high value later property values would mean that this strategy worked quite well. It seems that this will no longer be the case for trusts established after the 7th of June. But what will this mean? Does this mean the end of inheritance tax planning for financial services based trusts? The answer is a resounding no. In some conferences I've been speaking at over the past few weeks, I've asked now in excess of 200 advisors whether, and if so to what extent, they used RISAF strategies to create trusts with financial services products, to create pilot trusts, to create protection plan trusts, and so far I've had 2 people who have said that they've actually executed one of these strategies, in both cases in relation to life policy trusts. So will these strategies work for life policy trusts, pension trusts, loan trusts? The answer is to an extent, because when we work out the exit charges in the first 10 years, we look at the value of the trust property immediately after the trust was created, which means that you buy yourself 10 years with low value entry property, you buy yourself 10 years of no exit charge. And when you come to the first periodic charge, if the value of the trust property at that time is below the value of the nil rate band attributed to that trust, then again you will have a nil charge on the periodic 10-year anniversary. So that means because the exit charges are hooked to that previous periodic charge, if you get a nil rate periodic charge, you've bought yourself another 10 years of freedom on exit charges. So as long as your settled property has low entry value, you will have no exit charge in the first 10 years, i.e. a value that is below the nil rate band attributed to that trust. And as long as your settled property is lower than the nil rate band attributed to that trust at the 10-year periodic charge, you will have no exit charge for the 10 years following. So for many trusts, this will continue to be a valid strategy, because even with a split nil rate band, you will still have the likelihood that for 10 years following entry and 10 years following the periodic charge that there will be no charge. Now the problem will arise is that if at the time of a periodic charge, because it won't be the case on entry because we're talking about low value entry property, if at the time of a periodic charge there is value in the trust property that exceeds the nil rate band attributed to that trust. For example, if a life policy had paid out the sum assured, then we're not looking at a policy value and it's a protection plan with no surrender value, and the individual's not in serious ill health. If the policy is paid out and say they don't want to pay the money out of the trust because the children are too young, for example, and you reach a 10-year periodic charge and you have trust property in it that has real value, then you're going to have not only a 10-yearly charge, but then an exit charge that will be based on the value of the trust property that is actually exiting, which will be quite significant. So yes, it will be less effective to use fragmentation strategies for low entry value property and high value exit property, but it doesn't mean that inheritance tax planning is dead. There are some good examples in the TechLink bulletins that I referred to earlier. For pension trusts, there may be a small anomaly, because for trust-based pension schemes, the date at which the trust was created, according to inheritance tax legislation and interpretation right now, is the date when the member entered the pension scheme, not the date when they set up the pilot trust to receive the death benefits. So if the law remained as it was, it would seem that individuals who joined a pension scheme, a trust-based scheme, before the 7th of June, would have the ability to establish a pilot trust even now and be taxed under the old rules. We'll have to wait and see when we get the final legislation as to whether that opportunity still continues. So I would refer you back without a shadow of sort of doubt to the TechLink bulletins to get more detail on this subject.